You've probably seen hundreds of videos about the classic three-fund portfolio. But here's the truth. There isn't a single version that's built purely for growth. That's why I created one. A simple mix of 50% QQQ, 25% XLG, and 25% IWF, what I call the Enhanced QQQ Strategy. And the results are incredible. This portfolio has returned around 20% per year over the past 15 years, keeping up with QQQ's explosive performance, but with more diversification and a smoother ride. In today's video, I'll show you how this strategy stacks up against QQQ itself, SPY, the S&P 500, and Jack Bogle's traditional three-fund portfolio. We'll also break down the momentum behind this growth, so you can decide whether this approach deserves a spot in your portfolio. And just to be clear, there's no one-size-fits-all solution. Every strategy has its own pros and cons. Please consider your personal situation and goals before deciding what works best for you. Before we dive into my strategy, let's talk about the background of three-fund portfolios. The original concept goes back to the legendary Jack Bogle, founder of Vanguard. He never packaged it himself, but his followers, the Bogleheads, created the classic three-fund portfolio: 60% in U.S. total stock market, 20% in international stock market, and 20% in U.S. bonds. It's simple, low-cost, and incredibly diversified. The idea is you own everything: American stocks, global stocks, and bonds for stability. But the trade-off is slower growth. Since 2009, the traditional three-fund has delivered around 12 to 13% annually. Safe, but nowhere near QQQ's explosive returns. Now, fast forward to YouTube. A lot of finance creators are pitching their own modern three-funds, often something like 50% in VOO for broad U.S. exposure, 30% in QQQ for growth, and 20% in SCHD for dividends. It's a nice mix, steady, diversified, with some income. But again, it's not designed for maximum growth. The dividend tilt slows down compounding compared to a pure growth focus. That's exactly why I built my version. 50% QQQ, the NASDAQ 100 ETF, 25% XLG, the S&P 500 Top 50, Megacap ETF, 25% IWF, the Russell 1000 Growth ETF. It keeps the simplicity of a three-fund portfolio, but with one clear purpose: to maximize growth while still being more diversified than QQQ alone. Now let's look at the numbers, because results speak louder than theory. First, lump sum investing. If you invested in July 2010 and held until today, here's the annualized performance. My Enhanced 3 Fund, 17.8% per year. Classic 3 Fund, 10.2%. SPY, 14.2%. QQQ, 19.1%. So over 15 years, my portfolio nearly doubled the Classic 3 Fund, landing right between SPY and QQ. You get QQ-like growth, but with added diversification. Looking at shorter horizons. Over the last 3 years, my strategy returned 22%, while the Classic barely cleared 11%. In just the past year, it delivered 21%, almost identical to QQQ, but far ahead of the traditional mix. Now let's test dollar cost averaging. Starting after the global financial crisis in 2009, 18% annually. From the 2018 trade war, 19.5%. From the COVID bottom in 2020, 19.1%. And from the 2022 bear market low, an incredible 27% per year. So whether lump sum or DCA, whether over 15 years or just 2, this Enhanced 3 Fund consistently delivers explosive growth, with more balance than going all in on QQQ. Now that we've seen the performance, let's break down what's actually inside this portfolio, because the funds themselves explain why the numbers look the way they do. QQQ, the NASDAQ 100 ETF. This is the high-octane growth engine, stuffed with Apple, Microsoft, Nvidia, Amazon, Meta, and Tesla. Basically, the who's who of tech. XLG, the S&P 500 Top 50 Megacap ETF. Think of it as the VIP list of U.S. stocks. Berkshire Hathaway, J.P. Morgan, Johnson & Johnson, and the list goes on. These mega caps add stability outside of tech. IWF, the Russell 1000 Growth ETF. This one casts a much wider net, covering over 400 large-cap growth names across tech, healthcare, consumer, and industrials. It makes sure you're not just betting on a handful of giants. I've actually covered both XLG and IWF in dedicated videos before, so if you want a deeper dive into how those ETFs work, check those out after this one. So why combine them? Because it strikes the balance between concentration and diversification. Here's the breakdown. Nearly 50% of the portfolio is in the Magnificent Seven, compared to just 34% in SPY. A deliberate 15% tilt toward the market leaders that have driven most of the growth. Tech exposure of other big techs is heavier too. 22% here versus 12% in SPY. That's not an accident. History shows tech has been the engine of returns. At the same time, I haven't abandoned value. Through XLG and IWF, you still own Berkshire Hathaway, J.P. Morgan, and other stalwarts that help smooth out downturns. And unlike QQQ, which stops at 100 names, this mix spreads across nearly 450 companies. Over 230 of those also overlap with SPY, giving you a built-in safety net of broad diversification. The result is simple. I get QQQ-like upside, but with more depth and balance. More growth than the classic 3 fund. More focus than SPY. And more diversification than going all in on QQQ. That's the essence of this enhanced 3 fund strategy, designed for maximum long-term growth without going reckless. So that's the enhanced 3 fund strategy. It's not just theory. The backtests show it's delivered stronger returns than the classic 3 fund, while keeping more balance than going all in on QQQ. You're getting the best of both worlds, growth powered by the Magnificent Seven and tech, but anchored by megacaps and broad diversification. If you want to dig deeper into the building blocks, I've already made full breakdown videos on XLG and IWF. Those will give you the complete picture of why they're such powerful complements to QQQ. Check the links in the description or end screen to watch those next. And of course, don't forget to like, subscribe, and hit the bell so you don't miss more strategies like this.